what are you noticing about some of the big trends that we're seeing, knowing, of course, that that is from last quarter?
Yeah, you are seeing hedge funds buy into financials and energy as you would expect, but what are those names? We are finally getting the answers from the likes of Berkshire Hathaway and Stan Druckenmiller's Duquesne, who have bought into Chevron. We also know that Berkshire Hathaway has bought into Activision right before that deal was announced, so that's another big gainer that has come up. What are some other big names? They're not as you would always think, Taylor. There's Roivant Sciences, which was one of the buys of Viking. You have AT&T, which was positioning-wise one of the biggest buys. Hertz Global, which is down significantly on the year. Another huge buy of one of the a lot of the funds in aggregate in the last quarter of last year. My personal favorite, though,
do it.
Since we're talking about Hertz, also to talk about Avis, because one of the top paid money managers of the year in Bloomberg's Big Take had made a lot of money in the large concentrated bet on Avis, which is down this year less than you see Hertz.
Which they've been betting on for years, right? And finally it paid off. And it's a good thing that we had Avis's numbers just coming out today. But I'm interested in what the broader picture is you can tell us here. Hedge funds are meant to do well no matter what the market did, but they don't. Are we seeing some sort of outperformance once again?
So last year was a very divergent year, and we've seen a lot of money managers fall off of that list. Think Viking, for example. Think Chase Coleman and Tiger Global, which for very many years had become a shooting star in the world of hedge funds. Melvin Capital also. But you saw some funds do very, very, very well, particularly some mega funds, which includes Citadel. Izzy Englander has also been doing very well.
And now, why? What are they doing that's right?
You know, it's interesting because there is a lot of diversification here. If you were a long-short equity fund alone, you got crushed, and you are continuing to get crushed into this year. Macro funds did a little bit better, and now you're also seeing talent move to some of the bigger.
I always scratch my head at this, that when you have these big, gigantic geopolitical events, and then you see event-driven funds and macro funds sort of either lag or at least not perform up to snuff, like, isn't the whole point of these funds is that they tend to do well, or they're supposed to, but at least by definition, do well in these types of environments?
And what some of them will tell you is maybe we did less bad than the broader market, but at the end of the day, if you
that's a good point. Yeah.
But if you're a pension fund and you're losing money on your equity book and you're losing on the fund manager that you're paying maybe 2 and 20 for, you're going to be demanding outperformance this year more than any other. And again, the cream rises to the top.
With the event-driven, I'm thinking merger and arbitrage, right? We've seen a lot of mergers that we've talked even about today. Are those being able to see through in the performance?
That's the funny thing about it. No, in aggregate, the event-driven funds are not doing that well. But when you go back to that macro play, the interesting thing is, you know, the events that are driving performance are things you wouldn't think about. Think about a hedge fund that's focusing on Brazil, for example. Those types of funds have typically done a lot better at the very beginning of this year than other types of funds that are doing kind of the older strategies of the past. The other thing, guys, that's just a very big point of question is the funds that are betting on the private markets. And now the hedge funds that are moving more into private rather than these choppy public markets, maybe they are worth being paid more for, or worth watching for a very long time to see how those funds actually perform as things continue to be tough.